Hello, everyone. This is Martin, and welcome to this really important video. Take a look at my trader friend right over here at the left, and he's slumped over and feeling disappointed with the trade that didn't go the way he expected. Now, this video is called When a Trade Wins But Doesn't. This is my ABC Free Signals review video for this trade signals I sent out last week from June 13th to the 17th. Okay, now, when I saw what happened to one of my trade signals this past week, I said, you've got to be kidding. I can't believe how I missed a fantastic winning trade by a costly 3-pip decision I made. In the video, I'm going to explain exactly what happened and show you my incorrect 3-pip decision. Traders often get caught up in ugly price retracements, hitting their stops and closing out their positions. Okay, this happens all the time. Worse, price then goes in the right direction, resulting in a winning trade. This also happens all the time. However, we're not going to learn anything unless we come up with some ideas that can possibly prevent this from happening. Now, there are no 100% solutions that will give us 100% winning trades. You all know that, right? But I'm going to show you a new idea that I previously taught my students many years ago. Okay, let's get started. Now, this is me. My name is Martin here. I'm the originator of the ABC Free Forex Signals, guys. And if you want to receive your free signals, there's no obligation, no cost. There's no opt-in form. There's no credit card information required. Absolutely free. Just send me your email to mine right here. You can see it down below. mskyj007@gmail.com. Okay. That's my email address. So let me know that you're interested, that you want to receive your free signals. I'll have more on this later. And I'm a proud Canadian trader. You can see the red maple leaf right here. So let's get started, guys. And before we look at the charts and show you the actual signals I sent out, I want you to pay attention to my humble disclaimer here. My free signal service is an educational program only. I'm trying to teach you how to trade correctly and not give you any specific investment advice. Now, only risk the money that you can afford to lose. And remember, money management is the key to trading. Anyways, that's it. You can read this if you want. Let's take a look at my summary. This is what happened last week from June 13th to the 16th, guys. And first of all, you can see there are no trades held over from the previous week, previous to this week right here. Now, this recent week, on June 14th, I sent out a free signal, sell the British pound, Japanese yen. It had ended up losing for approximately 131 pips. It hit our stop, and the currency depreciated by 0.80%. Now, this is the one right here. This trade is the one that I'm going to review in detail in this video and to show you that this really should have been a winning trade. But we'll get to that in just a moment. Now, the next day, on June the 15th, there was no signal sent, guys. I absolutely didn't see anything I like. Right now, the markets are very erratic, okay? And price basically for all the currency pairs just going up and down, up and down. There are no trending directional type of price action right now. Okay, so things are pretty choppy. And then on June the 16th, I sent out another signal, the Euro CAD. So that's the buy, the Euro versus the CAD, the Canadian dollar. The trade is still open, guys. We're currently in a small profit. Okay, so now the recent past week summary. Okay. And again, we did lose 131 pips. So that was what happened this past week. Again, the loss, currency pair depreciated 0.80%. And over the last 26, since I've started keeping these stats from the beginning of October of 2021 last year, we've still gained approximately 4,540 pips, guys. That's still really amazing. It's averaging 174 pips a week. And so far, the currencies have appreciated for all the trades since that time, approximately 29.35%. Okay. Again, depending on your individual account and how you're trading and so on, your account balance. I'm not too sure what you're up, but you guys all should be in profit if you've been with me at least since the beginning of October 2021. Okay, so let's continue with the very first trade. Okay, let me just take that off. And the very first one here is to sell the British pound, Japanese yen. Okay, now take a look at this small window right here. This is what I call my entry window. Okay. And let me just open that up. Okay. So this is exactly what I saw when I sent out my free signal. Okay. And just showing you our entry, I sent you was 162.45. So, right here. Okay, on this candle. So this is the signal candle right here. This is what I saw. And then we enter. And this, by the way, these candles close at 5 p.m. Eastern Standard Time. We are in the New York time zone. Okay. So each candle closes at 5 p.m. So after that, I sent out the signal, the entry 162.45. Our first profit here of 161.26. Our second profit 160.45. Okay, expecting price to go down. Okay, and then I do always give you a stop loss. You guys got to enter your stop losses. It's so important. And in this case, it's 164.89. Okay, so our stop was up here. Our entry is here, right here, expecting price to go down. Okay, so now I've set up this scenario for you. Let me just close this window, guys, and let's show you what happened. Okay. And I'm going to teach you a very important lesson. I mean, I know this, and I even failed to kind of listen to myself. I remember teaching this. What I'm going to show you today, I remember teaching this to my students many years ago, and I'll get to that in just a moment, and it could have prevented perhaps a loss. So anyways, right here was the entry again, 162.45. I'm just going to show you what happened, guys. Okay, and after the entry and the next day, price did close up right up here. You can see this small white body candle. Okay, so right now we're in a small loss of about 50 pips, not a big deal. Price you see here, we want to take a sell trade. Okay, expecting price to go down, and price right here is below. You see this big thick line? This is called the DTL, the dominant trend line. It's really just a 21 EMA, okay? And so when price is below the DTL, we want to take a sell trade. When price is above the DTL, we want to take a buy trade, okay? So this is what happened. The next day, it closed higher from our entry by about 48 to 50 pips. You know, and again, depending on where you got in, right? Okay, and so we're at a small loss. But then the next day it went up again a little bit higher. You see, we're still at the DTL line, and I want to just retract just for a second. After this day, and we see this candle close with a small white body candle here, I sent out an update email, and I do this for all of the trades. So hopefully you guys are paying attention to my update emails every single day. Okay. And basically I said, I want to lower the stop from 164.89 to here, 163.76. So right now, then our stop is right there. Okay. Right there. Okay, so price again is right here. The next day price went up, and this is the candle in question. This is what makes me really upset. And I'm going to show you a larger view. Okay, I'm going to increase the image here. Okay, let's take a look here. Let me take that off. So we got in again right here. Okay, let me just do that. We got in right here. Price closed up there. Okay, so everything's fine. On that day and that the evening, I said to lower your stop from 164.89 to 163.76. Okay. The next day, price went up first all the way up to there. Can you see it at the tip of my arrow? Okay. And that was 163.79, which is 3 pips above 163.76. Can you believe it? You've got to be kidding. Well, that's what I said. Because what happened next was unbelievable. Price went 3 pips above our stop. So it hit our stop. And so our trade is now closed. And then went all the way down. Look at that. That's a massive, more than 200 and something pips down. It did hit our first stop loss, 161.26. It hit our second stop loss, 160.45. So you can see when price went down, and if we're using the robot that I know most of you are using, the trades would have automatically been closed. We would have made a massive profit of over 200 pips. And then you can see when after price went down, price went back all the way up and closed here again with a small white body candle. So that's the close of this day here. This is called the entire trading range of the day from here to here, right? And price closed there. So we missed our opportunity by 3 pips because we lowered. And I don't know if a lot of you did. Most of you are following my process, following the information I send out to you. And if you did lower your stop to 163.76, you also would have been stopped out here, right here, when the price of this candle, you see this upper wick, this upper line hit 3 pips above 163.76. So very disappointed. This should have been a massive win. Instead, it ended up being a loss. So that's really the theme of my video. When a trade wins, but it doesn't. Okay. And this happens occasionally. Okay. We normally have our stop right here. You can see this is called a catastrophic stop loss. It is actually 1.5 times the ATR above our entry. Okay, so if we would have left our stop here and with this candle price just went to here, we would have been good. We would have had a winning trade. But when I try to lower my stop as much as I can. A catastrophic stop means that if price from our entry again, let me just take that off. Okay, I want to clean up the chart just for a second. Okay, so our entry is here, okay? And if right after our entry, price goes all the way up, I mean, would have to go up by more than 250 pips. That's called a catastrophic stop loss. So this is in case that there's a world major event or a crisis or something that makes price go up that high. At least we get out. At least we do have a stop, guys. And it's so important to have stops. In this case, it's 1.5 times the ETA of this candle right here. And guys, remember, these candles are daily candles. We're not intraday. We're not scalping. These are not 15-minute candles, 5-minute candles, or anything like that. They're not hourly candles. They are daily candles. Okay, so that is quite reasonable to have a stop there. Otherwise, the gurus tell you to have a stop way above a previous resistance level. If you're expecting price to come down, they want you to place above a previous resistance area, maybe above this candle right here, or right there. I don't know, but anyways, the process is we have a catastrophic stop here, and it's okay, and then just lower the stop, especially if price goes in our direction. Now, price went slightly higher, and I still want to lower the stop. Now, we're not going to learn anything unless we come up with some ideas or solutions, and this is what I'm getting at. So bear with me, guys. I've got a bit of a solution, and I've got an idea I want to share with you. Now, before we do that, let's go to the final trade signal I sent out is the buy Euro CAD. Okay, this is the entry. Let's open it up. Okay, there we go. This is exactly what I saw. So here's the signal candle right here. You can see it was a big white bullish candle showing good momentum, really good momentum coming into the markets. Okay, and we got in. So signal candle. Here's the entry candle at 1.3653 right there, guys. Expecting price to go higher, at least reaching our first take profit of 137.32, or our second take profit 1.3781. Here's our stop loss, guys. Again, this is called a catastrophic stop loss in case price from here goes all the way down immediately because of some sort of major event that causes price to crash. Okay, and that's why we have that. Okay, but most cases, by the way, this doesn't happen too often. It's happened very rarely in our trading history, and so I'm quite confident having it there. Okay, again, if you're where else would you put a stop loss if you're trading the daily candles? The gurus tell you to put it, in this case, if you're expecting price to go higher, they want you to put a stop loss below a previous swing low, right? Well, here's the previous swing low. Here's the previous, or you can put it here or below this candle, right? But that's still lower than where we put our stop, which is 1.5 times the ATR. Okay, so they say if you put it down here, then whatever the distance is from here to here, let's just call it a one risk, then they want you to have the same reward, one reward, which would make it up here. So price would have to go up to here for you to have a 1-to-1 winning trade. Okay, my process is a little bit differently. Hopefully you're enjoying it and understanding what I'm doing. Okay, so this is what we saw when I sent out the signal. Okay, and let's close this window. Okay, and we're going to take a look, see exactly what happened. Now again here, this is our entry, okay? And you can see on this day that we got in, price went all the way down to here. You see the lower wicker line. Price went down, then went all the way. I'm sorry, price probably, I don't have the other charts open, but price went up high first. It went all the way here, then went down to here, and then closed up to here. Okay, so we have a small white body candle. We are in a small profit position so far, and basically keep the trade open. Let's see what happens at the beginning of this new trading week. Okay, here's the first take profit target, second take profit target, and our stop loss over here. So that's what we can show you for now. Okay, so let's get on to the lesson. We're going to pay attention again to the to this trade, the sell the British pound, Japanese yen. We're expecting price from here to go down. Instead, it started going up. Okay, so what I want to show you and talk to you about is institutional price levels. Now, I taught this to my students quite a number of years ago, and occasionally I've used it, but in this particular case, I forgot to use this. I forgot to apply it to this trade to sell British pound JPY. But basically, what it means is that there are levels on your chart where price can be expected to bounce off of or be rejected. And these are called institutional price levels, and they involve the 80, the numbers at the numbers 80 and 20. Okay, these are the price levels here. Now these numbers, the 0 levels, okay, you probably all know that these are the psychological levels, or we can call them round numbers. But the institutional levels are a little bit different. Okay, and price often would let's say if price is coming down, okay, price is coming down, would come down to the 80 level, maybe a little bit lower, then be rejected and go back up again. Okay, so for a buy trade, price would go here and then reject it and bounce off the 20 level, okay? And then maybe back again, test it, and then and so on. So that's what we mean by the 80-20 levels, okay? I taught this, and I'm going to institute this in the future for our trading with regards to placing stop losses, okay? And this is very, very important. Okay, so I'm going to review the trade and show you what we should have done, what we did do, and why we had a loss. Okay, let's review the trade. And here was our entry for the sell British pound Japanese yen. I'll refer back to the actual chart in just a moment. The entry was at 162.45 right here. This is where price was. And I was expecting price to go down. Okay, instead, price went up. It went up to this level, 162.93. When price went up and the candle closed, I then sent out an email update asking you to lower your stop from this level, which is 1.5 times above the entry candle and 1.5 times the pips, okay, for the ATR. And I asked you to lower your stop down to this level, 163.76, right? Again, you can refer to your notes and see that that's correct. So that's what I asked you to do. Now, from here, price instead went up all the way to here. And the high of that candle was 163.79. Now, because we had our stop loss here, okay, I asked you to lower the stop loss here. And by the way, I did the same thing. When I give you the instructions or the updates, I do exactly the same thing as per my instructions. I take all the trades like you guys. And so I got stopped out as well by 3 pips. You see, the pips, our stop was 163.76. And our lowered stop, in price went up, and the high of price on that candle was 163.79, 3 pips above 76, right? So that's where we get the 3 pips, and that was my mistake, and I'll tell you why. Okay, I didn't use the institutional levels. In this case, for this trade, the institutional level was 163.80, okay? And also 163.20. So I should have lowered the stop. It's okay to lower the stop, but I should have lowered it to a few pips above this institutional level of 163.80. If we would have done that, and even though price went, the high of the price on that candle where we got stopped out hit 163.79, still lower. It still was below the institutional level of 163.80. Hopefully you understand that. This is what I'm talking about. Okay, so now you do this when you expect price still to come down. Okay, now in this case, remember we got our entry is 162.45. Price went up just a bit. Okay, to 162.93. Now from here, price was still below the DTL line. You see, this is the DTL, the dominant trend line, the 21 EMA. Okay, and from here, I was still expecting price to come down. Instead, it went higher, right? But when I'm expecting price still to come down in our desired direction, that's important to understand that, in our desired direction or our trade direction, then you can lower your stop, okay? But make sure it's above the 80 level, okay? Now, I want to take this off. What happens if you are in a buy trade? Okay, if you're in a buy trade, okay, and let's say your opening entry is here and expecting price to go higher, then you can move, and if your stop is here, then you move your stop to just below the institutional level of 20, okay, the 20 price levels. So if price is going higher in your trade direction, then you can move your stop higher, but make sure it's below the 20 level. Even if price right here comes down a bit, and you're still above the detail line, just detail, and you're expecting then price to go higher, then again, you move it to below your 20 level. Okay, so that's the way it works, guys. I'm going to adopt this in for every trade from here on in. And guys, it bugs me when I know I'm right and we should have had a winner. In this case, it was a winning trade, but it wasn't. Okay, and so hopefully you found this very educational, guys. And let's continue. We're almost finished. Now, my inspirational message is in trading, don't be surprised. Anything can happen. Okay? Always trade with stops. Learn from a huge price movements that reverse to take out your stops. So learn from that. Again, when you expect price to go lower, that's lower, okay? Then move your stop to above the 80 level. So you're moving your stop down. It's already higher, but moving it down to just above the 80 level. When you expect price to go higher, let's say on a buy trade, okay, then move your stop to below the 20. So your stop is below your buy entry, right? But you're moving it higher. Make sure it's below the 20 level. So that's it for this week, guys. I thank you very much for watching this video. If you want my basic free trade signals, send me your email address. There's no obligation. Guys, it's totally free. I mean that. There's nothing to pay. There's no opt-in form to fill out. There's no credit card information, nothing. Just tell me you want to receive your free signals. Send me your email to mine right here, guys. You can see that below. mskyj007@gmail.com. Again, mskyj007@gmail.com. And please give me your first name and the country that you live in. I'm always interested in hearing from people in different parts of the world. So guys, that's it. Cheers from Canada. Again, this is me signing off. And if you like the video, please click on the like button below the video. If you're a new subscriber, click on the subscribe button and hit the bell to make sure you get all my future videos into your inbox, guys. Take care. Bye for now, and we'll talk to you again soon.